Hey everyone, I'm Don Simmons with Simmons Capital Group and Stewart Advisors Group, and joined today with our new president, Rob Duncan. Rob, why don't you say a quick hello and give a quick bit of your background? I think that would be worthwhile.
Yeah, absolutely. Don, it's great to be with you and with everybody virtually. Look forward to meeting everyone, as many people in possible in person. But it's a fantastic opportunity to be a part of the team here. Fell in love with Don's mission and vision for both Simmons and Stewart and the direction that he's cast us in. I'm just super excited to be a part of it, and it's really because of that vision and because of the team that makes this such a special place to be. And just excited to be here. Been in this business a long time, and it's great to be on the journey with other people who are also committed to delivering phenomenal financial advice to our clients in all seasons, be them good or a little bit more rocky, like we're experiencing right now.
Yeah, so that's the reason for our recording today. This conflict situation in Iran has lasted longer than I think some of us expected.
Yeah.
And so uh, our market minute for this quarter is titled War, What is it good for? And this is a question that's not new. In 1970, at the height of the Vietnam War, soul artist Edwin Starr released the iconic protest song called War, a song that didn't whisper, but it actually shouted, uh, What is war good for? Absolutely nothing. And it was this cry from the human heart, a recognition that whatever war produces, it comes at an extraordinary cost.
Yeah.
And yet, markets don't always behave that way. War moves capital both for good and for bad, and it creates winners and losers. So today, we're not going to take a long amount of time. We've basically got five questions that our clients are asking either by phone or by text or by email. And I thought it would be good just to answer these questions in a group format. So we're just going to hop right in with these questions in terms of, do we react or do we stay the course? So the first question, will this war situation in Iran cause oil prices to spike, and will they stay high, or are we expecting something different? If you'd like to take a stab at that, I have a couple thoughts, but what are your
Sure.
thoughts?
Well, I can tell you as someone who's just uh, came back to upstate New York from Southern California, I can tell you oil prices have spiked. I was in LA the other day at a conference, and oil prices, I saw some gas stations over $8. So, look, those are in really, really difficult spots and probably where places are hyper inflated more than they need to be. But yeah, I think in the short term, I don't think we have any doubt that oil prices will spike in the short term. I think the key to that question is, are they going to stay elevated long term? The second half of that question, and I think that's where the answer, again, we've seen this repeatedly over time and over history through multiple conflicts. We even saw it as recently as like 2022 with the Ukraine-Russia conflict. Oil spiked, and then it after kind of the conflict sort of starts to die down, we start to see it pull back again. And we've seen this repeatedly through time. So again, if the conflict can be relatively short-lived and maybe drags on for a few more weeks, but if it gets resolved, we should start seeing the Strait of Hormuz open up, and we should start seeing oil prices start to migrate lower after this, I would think.
Yeah, so that's really the big variable in all of this is the Strait of Hormuz and how long is it going to be constrained. Um, Oil has touched here in the States over $100 a barrel, which is a pretty high price. Although, if we look back just about 2 or 3 years, oil was significantly higher than that, and there
Mhm.
wasn't even a war situation. Um, but one of the charts that I found interesting, and we'll put that in here, is basically various countries' dependence on uh, oil imports. And the US stands at one of the lowest points that it ever has in history and is one of the lowest in terms of countries that depend on foreign oils for import. Our dependence is actually minus because we are a net exporter of
Right.
energy compared to a net importer. The countries that are going to fare the worst on this are actually Germany, South Korea, Japan, Taiwan, and the EU in general, who are all 70 to 90% dependent on energy imports. So, from the standpoint of is this another 1970s kind of situation where we're going to have, crazy long lines at the gas station? I don't think that's the case because we're just not as dependent on the oil. In fact, the Strait of Hormuz really doesn't affect the US. And then the second piece, and we might talk about this a little bit more relative to the economy itself, energy as a sector percentage of the equity market capitalization for the US is only about 4%. So even from a stock market standpoint, the energy sector just doesn't play as big a role as it used to in our overall economy. So I'm with Rob on this one that the dislocation is significant at the start, but I think that we'll work our way through this, and hopefully by the summer or so, it will have worked its way through the system, and gas prices and energy prices will be back to somewhat reasonable levels. Any other thoughts on that, Rob?
Yeah, I mean, again, just a reminder, it was I think we peaked over 128 in 2022 with gas prices, so we're still not 128 dollars per barrel, so we're still significantly below that peak. And you're right, I think when we get into the summer, we'll start seeing a decline. The one thing that may keep them a little bit more elevated through the summer is the summer driving season. It typically sometimes rises up prices a little bit in the summer, anyways. So even if it does. They may come down, but they may not seem like they're coming down quite as quick as everyone wants if it lingers into the summer. But other than that, I think you're exactly spot on.
Yeah, I mean, the pain at the pump hopefully is going to be temporary.
Yes, sir.
Well, another question that seems to be on everybody's mind is, so we've seen, what's almost a correction in the stock market. Some of the indexes have gotten close to a 10% drop from their peak. Is this short-lived, like we think energy prices, or is this the start of something bigger? What do you think?
Well, for me, like every investor, right, our portfolios go down sometimes too, and we feel it. And so for me, I know personally, I have to step back and say, okay, let me take a look historically. And the one chart that I really love shows the intra-year volatility on the stock market every single year. And when we look at it, most years, I think the average decline going back to 1980 is roughly around 14% per year from peak to trough. And what that means is that in any given year, we have an average downward move of almost 14% on average over this time period. And even I looked at another one, we moves of 5% more or down happen multiple times a year, typically, as we look back over the history of the markets. So what we have to remember is this type of volatility is actually quite common, and we experience it, and it's part of the trade-off that we get for getting the reward of being an investor. We sometimes we take the risk level or the fluctuation volatility of the market as well that goes along with it. So we have to remind ourselves that sometimes just because we're experiencing some volatility, that doesn't mean that something really catastrophic is going on. And I think that's part of our jobs is to continue to try to monitor these situations and see when does a pullback and a temporary pullback turn into more of a long-term systemic type thing where we're really seeing an economic shift that needs to be factored in and really work through the system that might take multiple years. And at the moment, I think we're not quite seeing that yet. Oil shocks have had the tendency to lead to some of these things, but again, they tend to be more prolonged, longer-term oil shocks.
Yeah. And if we're talking about war itself, not oil or energy shocks, I'm going to put in a visual slide here. The source of this is NASDAQ Dorsey Wright, a historical guide to asset class performance around wartime. And this goes all the way back to World War II in 1941, through the Korean War and the Vietnam War and the Gulf War and Afghanistan and Iraq, et cetera, right up to this skirmish in Iran. And it looks at the performance of the S&P 500 index on 5 days from the start
Hmm.
of the disruption, 20 days, 30 days, 90 days, 180 days, and 1 year out. And you can see that um, in almost all cases, there's a significant decline right out of the gate in the first 5 days and 20 days and even 30 days. But by the time you get to 90 or half a year or a full year, um, the numbers don't look that bad. In fact, the average return for the S&P 500 a half a year, 180 days after a skirmish begins, is 4.47%, and a
Right.
year out, it's 7.5%, with times that the half a year was as high as a 72% growth, and a year out as much as 63% growth. Now, we're not expecting that, but if this is normal of what we've seen many, many times in the last 70 years, then we would expect that this will rebound and we'll see reasonable rates of return
Right.
coming up after that. Another question that people are really asking about is, with energy prices going higher, that tends to be inflationary. So we're expecting short-term inflation. What do you think, Rob, in terms of the longer term? And what about interest rates and the Fed? Do you think there will be any change in the consensus from where we were a month or two ago when everybody was kind of anticipating a rate drop or two in 2026? What do you think?
Yeah, everything I'm reading and what I'm hearing, the Fed watchers talk about all this sort of stuff and the comments that we're hearing out of the Fed is that I think we're still on the books for having some rate cuts this year, but I think they're going to be pushed out farther in the year, and they seem to be looking through this sort of increase in prices. So it's sort of like a temporary inflation bump with the oil prices going up, but they see them coming back down again. So they just see they're trying to look through this. And so, in other words, no, we don't think this is super inflationary. Might be cause costs to rise in the near term, but is it going to change the longer term trajectory of the inflation track we've been on? We don't think so. At least that's not what I'm not hearing anything out of the Fed watchers that say that. And some people are still thinking that we're going to have rate cuts from where we are today. Even I think potentially the new incoming Fed chair that President Trump wants to bring in, who's been very dovish on wanting cuts to the market, has even said there's still going to be cuts coming forward in the markets in his latest commentary, I think that came out earlier this week. So he's still seeing cuts coming on the market. Now, he doesn't see as many cuts as he had maybe proposed a few months ago, but he's still seeing rates coming down from where they are today. So I think that's the important thing. But it may not come down as much as everyone wants them to come down in the near term, at least.
Yeah, I think the wild card in this is how long this drags on. The longer
Yes.
it drags, the worse, really the worse the scenario is for oil prices, for the stock market, and I also think for inflation. And so watching the data over the next 90 days to 6 months will really determine what the Fed is able to do. I think they'll be hard pressed to make a rate cut if inflation is, above the target to any
Right.
significant degree. So
Right.
his hands may be more tied by the data than what he really wants to do.
Yeah, absolutely, absolutely. You're right. If it's and like I said, it's all assuming they can look through this that there's going to be another side of this fairly quickly. If it like I said, prolonged conflict is never good for all this sorts of things.
Yeah.
And,
Um,
sorry, one more thing, Don. And oil's one of those factors, right? That just it ripples through everything. It under its transportation costs, and so when you see energy costs go up, that's it. It helps all businesses need energy either to produce their products, to ship their products, to transport their products, whatever it is. Or some of the petroleum products go into the manufacturing of those products. And so it's one of those nefarious things. That's why the oil shock tends to be problematic over the long term. But again, this isn't a supply issue. It's not that there's no supply or the countries are pulling back producing or anything along those lines. It is literally just the Strait of Hormuz being closed, where 20% of the world's oil goes through it. And so as soon as that spigot gets opened back up again, oil starts flowing again, and we can see prices adjust very quickly, probably much faster than having to bring production back online.
Yeah, that's certainly something very important for us to note that this is not it's not really a supply issue, it's a delivery issue.
Correct.
Good, good. So, what parts of our portfolios are most vulnerable or most resilient in this period of time for the next, uh, you know, 3 to 6 months?
Sure. I think it's the things that we look at anytime there's a market shock, right? It's stocks that are overpriced or have been overpriced in the market and seem expensive. Those are always go. Things that might be directly impacted by a spike in energy costs would be some other ones, and things that are, I think, of a lower quality. That would see things go up. And also, if we see interest rates potentially move, there could be on the fixed income side, longer bonds could tend to be hurt in that respect as well.
Yeah, that's if this drags on and if
Right,
inflation persists, and then as a result of that, if interest rates have to rise rather than go down. So there's a
right,
number of ifs there in terms of long-term bond performance. As our clients would recall, bond prices change inversely with interest rates. So if interest rates rise because of inflation, bond prices will fall. And the
yep,
longer the term of the bond, the bigger that price change is relative to interest rates. So, we're hoping that this isn't long lived. Now, some of the things in our portfolios that are resilient and that are holding up well would be stocks that were undervalued a year ago, that weren't part of the Mag 7, that were extremely overpriced. But small and mid cap stocks were not overpriced, and those have held
right.
up fairly well. Dividend paying stocks, also what would be called value stocks, hold up in a volatile market environment or an environment where people are unsure of the future. And then, we've been talking for the last couple of years about the alternative investments, the commodities and precious metals and trading strategies that zig when the market zags.
Right.
Those also are faring very well in this kind of environment, and we're very pleased with the performance of our portfolios. Usually the corollary question that people ask is, what changes are we going to make based on the current, conflict and volatility? Rob, are we planning to make any significant changes in the portfolio?
No, I don't think we see the need to make any significant changes right now. And I think one of the things that is key for everyone to understand is that we build diversified portfolios from day one. And so when you go through market dislocations like this, there are some aspects of the portfolio that get hit a little bit harder. But there are also other things that get buoyed by this. So for example, the oil and gas industry and some of the energy stocks have gone up about 25% through this crisis. So we're seeing some aspects get hit, other aspects of the economy, even as the broader markets may decline, we're seeing pockets of outperformance in certain aspects of the market, and you don't get that unless you're fully diversified, and that's what we like to do.
Yeah, so that leads us to really the last question. Do you think that this could tip the global economy into recession?
I mean, Don, we can never say never, right? There's always a possibility that, again, it could. And I think the caveat that I think we've said multiple times throughout this is this: if this is longer term, or if we see this conflict really expand into other countries, into other areas, then it's a possibility that we could see this tip into something. But all indications from pretty much all sides on this one, it's the at least the what we're hearing, the messaging keep coming out is that this will be short-lived. This will not be long-term. This will be a shorter-term conflict. And so if that is true, and if that does hold true, I don't see that as a risk, but we can never say never, of course, right?
Right. Yeah. So the things that we'll be watching are oil price spikes. How long is that going to stay up? Uh, will there be slowing global growth as a result of the higher oil prices and the disruption? And is there rising inflation? Those are
Right.
those are really the critical pieces that we're going to keep our eyes on to determine how long and how deep this could be. But at this point, we're not anticipating that this turns into a global recession. Some of the implications on people's financial plans.
Well, first of all, make sure that you have a plan, right? I mean, I think that's the key one. Make sure that you have it and that you have one in place. But I think it's a time just to make sure you're revisiting that you have adequate cash reserves on hand, that your risk tolerances are accurate. And sometimes for some people, this might be some of the first markets they've gone through, or others they've been through this before. And just make sure that the what you're experiencing in your portfolio still matches up with how you feel and how your personal tolerances are with the portfolio. And then yeah, just making sure that that you have those adequate cash reserves, that you're well positioned to go forward with it. I think that's the biggest thing. Make sure that you have a plan and reminder of why you have the plan and that you're sticking to it. Now, if something major has changed in your life, or if there's a life situation that's changed, obviously that's where the plan typically needs to get modified, not necessarily a short-term market dislocation. So really, again, we don't let short-term market dislocations disrupt our financial plan. It's more how does our life is there any changes in our lifestyle or in our situation that would dictate a change to the financial plan more than the markets?
Yeah. So I think it's fair to say that relative to a recession, it's a matter of when, not if. There will be a recession. We don't see it imminent today, but there will be. And so that's always a concern in the back of our mind. If you are retired and drawing income from your accounts with us, we already prepared at the end of last year when we rebalanced and we took
Right,
profits off the table with the stocks that did extraordinarily well.
right,
And we increased our short-term bond positions, specifically with folks who are drawing income.
right,
The key to recessions and volatility is you need to have time to ride through the peaks or the valleys. And,
right,
we're well diversified. Make sure you've got your emergency fund in the bank, and focus on your long-term goals. And I think we'll all be fine. But our portfolios are already positioned. We believe in the basic rule of investing, which is buy low and sell high. And unfortunately, that also means that there's some tax implications. We've done everything we can to match uh, harvestable losses with any gains in most of our accounts. We really don't have anything left in terms of losses to harvest.
right.
But if there's a recession, we will harvest losses and keep those in the bank, if you will, for the future. So
Silver
all in
linings.
all, we're not overly concerned about this current situation. I think we're well positioned, and we'll continue to monitor the progress. Any closing thoughts, Rob?
No, I completely agree with you. I mean, look, we grieve anytime that there's conflict around the world and there's violence and our men and women in the armed forces are put in harm's way and there's damage and loss of life anywhere in the world. We grieve that, but as we go through this from a financial perspective, we do believe this is going to be short term and yeah,
Yeah, war and geopolitical conflicts are undeniably serious events with real world consequences. And yes, we do grieve for the casualties and the disruption in people's lives. But from a market perspective, the goal remains the same, to stay
Right.
aligned with our processes. We watch the news cycle. We don't get panicky over what seems to change on a daily basis.
Right.
We're well positioned to ride through this storm. So, Rob,
Yeah, no, I completely agree with that. And I think we've seen moments where the markets have traded off of a social media post or something. So to make knee-jerk reactions, we miss all those opportunities that come out of the mix. So we just have to ride through it.
yeah. So those are our thoughts for this week at least. We'll see what next week holds. Thank you for the trust that you've placed in us. We take that seriously. We're honored to be your advisors. And if you do have any questions or concerns, feel free to give the office a call and talk to your advisor. Thank you very much and have a great day.